viewers and investors. Welcome to another episode of our exciting and informative webinar designed to make your investing journey little less puzzling. This episode is spearheaded by Yes Securities. I am Kundan Kishore, Deputy Editor, Outlook Money, the host for this session. And today we have an exciting topic to discuss, that is ABC of stock investing. In this episode, we will demystify the essential concepts and strategies to help you navigate the world of stock investing. To guide us through this insightful journey today, we are privileged to have Mr. Anshul Arzare, CEO of Yes Securities. Welcome, sir.
Thank you, Kundan. Thank you for hosting me today.
Thank you, sir. It's our pleasure. So without any further delay, let's explore to the fundamentals of stock investing now. So, sir, I'll come to the questions now. If you can just help our viewers to understand how to invest in stocks, and if you can just guide them how they can open Demat account, whether they should go for full service Demat account or discount brokerage account. If you can just give some insight on that, that will help our investors, viewers.
Sure. So Kundan, starting from that, how to start investing, into a stock
Right.
and how to select a stock. So basically, when we say I want to start investing into a stock, is basically which stock to purchase. Buy. So fundamentally, it's a very simple theory out here that if you're investing into a stock, you're basically investing into that company. You're buying the shares of that company. That means you're becoming a partner in that company to that extent, to whatever small extent you're doing it. Now, when you're becoming a partner to a business activity, what in a commonsensical basis, what will you like to, whom you like to partner with it? You like to partner with somebody who is growing, so that your money which you have put into as a stakeholder or a shareholder, as a partner of that company to that small extent, also grows. So when you're doing that, very, very basic things, what one should understand from first perspective is that what is the business model of the company?
Right.
So if the business model is good, if the business is happening, if the revenue is generating, then definitely you will get a return. As simple as that. So it's a very, very basic thing. What is the business model of that company? Then another important thing, what one can always look at it is which industry this business is into, and how is the outlook of that industry. And within that industry, how is the outlook of the particular sector? It's very simple that if a particular industry or a sector is going to do good, because there's a demand for that, as a consumer's demand is there, definitely the companies into that particular sector will also do good. So again, very, very basic commonsensical approach out there on that. And another thing, now when you specify, try to see that, okay, this industry is going to do good and there are certain companies in this industry. Now the question is which stock to select in that industry. So that selection can come from that various business model of the companies and which particular companies have a distinctive advantage. How old they are into the system, since how long they are running the business, what is their profitability track record, and what is the market capitalization of the company. Why I say market capitalization is important, because if the market capitalization is large, that means it would not have become large overnight. So that means that company has performed good over a period of last 10 to 12 years, which can give you a lot of confidence that if the company has performed good over the last 15 years, then there's a high probability that the consistency will continue and you will be able to get that returns out of it as compared to a new entrant into the market. How to correlate it with another aspect out here is the management. So ultimately, the company is a bunch of people. It is not about the furniture. It is not about the infrastructure of the company. It's about the people who are managing the company. And if the management is good, and if the management is good, then only the company has survived and done good for the last 15, 20 years. So a track record gives you a confidence on the management of the company. While I'll not say that any new age company is coming out as a bad management, but only from the perspective that you don't have a track record available at this point of time. And here you have a track record available. So the fourth thing which you should look at, with anybody should look at, is overall management, how the management is all about. Is it a professionally managed company? Because that becomes very, very important. Company may be good, but if it is not managed well, it may not continue to be good over a period of time. So that's one perspective. And one more perspective, which nowadays data is also available, is around the corporate governance side. If as a corporate governance, we are on the right side of it, Then, so corporate governance, largely when I say, I see that what is the management's performance overall in the years to give a value to the shareholders, and not only to the shareholders but also to its overall stakeholders, which is the customers, which is the vendors, which is all people who are associated with the business operations of that company. So if the company treats the vendors well, if the company team treats the employees well, if the company treats the customers well, and so why will company do this? Because they want to be doing it in the right way. So if that is coming out clear, then you know that these are the practices which is going to sustain the similar kind of an performance or a better performance of the company over a period of time. But if there is a compromise on the corporate governance, then it gives you a perspective that probably there are shortcuts being taken. So these are the simple commonsensical things, I think, which helps to select a good stock when you are investing. And last but not the least, one more factor which you can one we can look at it is the quality of the earnings. When I say quality of the earnings, people are always aware of the earnings, what are there because the balance sheet is published. But within that earnings, what are the exact earnings which are coming out of the actual operations of the activity and not any other activities? Because other activities may give you some bulk revenue in 1 quarter or 1 year, but that's not the business model of the company. That's not the business model revenue of the company. So if the quality of the earnings also you look at it, then you get some fair idea as to that the whatever is the company is doing it right. So if
Right.
these are the couple of 5 6 factors, if one look at it, then you get to easily select a good stock um, to start investing into.
Sir, here I would like to ask you two questions from retail investors' perspective. First, the corporate governance part. It's quite difficult for a layman or a new investor to know about the corporate governance part because very few people have access to those kind of data. And when it comes to quality growth, what that mean? If you can just elaborate on that part.
Yeah. So yes, data is available today in the world of Google. So data is available. It's just that you need to do that extra bit to understand a bit on that side, and hence I correlated it with the market capitalization of the company. As I said, if there's a company is already a large cap company and is continued to being a large cap for over a period of years, that itself tells you that the company is doing right things on a consistent period of time. And that also reflects that if they are able to do this consistently for a long period of time, that means on the corporate governance side they would be good. Then only they can sustain these kind of an growth and value. So you
Okay.
can correlate these two numbers. So somewhere in a higher market capitalization, you get a sense that the company is doing something right for a long period of time. And when I said quality of earnings, when you look at it, the earnings, the small data in the balance sheet of the company, that earnings from the operations. So what is
Okay.
that percentage of earnings from operations as compared to other earnings? So largely, if you ask me, the best case scenario is 100% earnings are from earnings from operations.
Okay.
Because that's the company's domain expertise to do certain things, and that's the operations company is doing certain set of operations, and you are generating revenue out of that operations. If that is on the higher side, or is the maximum revenue is coming, that gives you a sense that whatever is published in the balance sheet is an outcome of the activities which the company is meant for.
So if I can simplify that for investor, so that is you mean to say that operating revenue, right?
So what happens, just to give you an example here, just to understand it, let's say there is a company who's into manufacturing, and over a period of time, he has also developed, created some assets, right? And in
Right.
some of the year, he or the company sells some assets and make some revenue out of it.
Mhm.
But that is not the operational revenue. That is some assets which the company has chose to sold, and obviously the return comes to the investor only. But at that year, what is that percentage? Because that is a one-off activity
That
which
year.
company will have. It is not a continuous
Yes.
activity of the company.
So, sir, if you can just help us understand how the stock market functions broadly, a stock market, the functioning of a stock market.
So it's a very fairly simple activity, if you ask me. So stock market is like a marketplace where buyers and sellers come. So when a buyer is putting his bid, Seller is putting his bid to sell price. So as simple as that. So now the good part is it is completely electronic. So when anybody who's investing and seeing a screen, what he's actually seeing is that how many people at the back end are actually buying and selling, because live data are available. So the exchanges brings the buyers and sellers seamlessly in on one screen, and people understand that what kind of an buying and selling is happening in a, overall in the market and in a particular stock at that particular point of time. So you come to know a live updates on exactly what transactions are kind of happening and what number of shares are exchanging hand at what price point these shares are exchanging hand. So the markets are a function of largely demand and supply, if I can summarize in one word. Because what is happening when you're buying a share, you're only buying when somebody is able to sell it. When you're selling a share, you can only sell when somebody is buying it. So it's not that in the market you are producing new shares every day. Shares are merely exchanging hands.
Yes.
So hence we say that whenever there is a demand, so that means there are more buyers. So if there are more buyers and less sellers, obviously the sellers will command a higher premium. So price, you see in price increase happening, because it doesn't happen that suddenly there are more number of buyers. So there is no extra shares being produced in the process. It's just that extra sellers are joining the bandwagon to sell the shares because they are getting a better price. Similarly, if there are lesser buyers, then sellers find it difficult to sell the stocks. So exchanges just bring in seamlessly the buyers and sellers in one platform and give them an opportunity to discover the right price. As we call in the parlance, the price discovery happens at the exchanges. So they allow them to discover the right price to trade or to transact at but on that particular day or at a particular point of time. So that's the biggest role exchanges play. And beyond that, they also with their governance activities, they ensure that your trades are settled, which is the biggest part which exchanges play along with clearing corporations. That if you have bought a share, your money moves out of your bank account, it goes to an if you sorry, if you bought the share, the money moves out of your bank account and if it goes to the seller, and if you have sold the shares, then the money automatically comes into through the settlement of the trade. So the biggest activity actually the exchanges does in this process is settling the trade. So executing a transaction is the simplest thing. You click of a button, 100 shares sold, but actually you receiving that money against that 100 shares is the settlement process, which also exchange facilitates.
Okay. So now investors got to know that why they should invest in stocks, how the stock market functions. So now let's come to suppose I have to invest in a stock. So what are the key metrics or key parameters like key ratios one should look at? Because ultimately, if you have to, everything is fine. You are investing in a high growth companies having good governance, corporate governance. Everything is fine. But how to find out that okay, this is the right price to invest in this stock in this company? So how one can figure it out?
So the actually deciding on the right price is, let me tell you, is a very difficult job, because I said it's also a function of liquidity, which is demand and supply. So while the company is growing, but it's in too much in demand, so the value, the price which you are paying to acquire the shares at the point of time may not be justified in perspective of the overall business numbers of the company, but they become justified depending on the demand and supply aspect of it. So when you correlate the demand and when you add the demand and supply aspect, then that price may not be justifiable in terms of pure business numbers, but it becomes little higher because there is more demand. So you have to always factor in the two things in this market, or any stock market for that matter, is what is the demand and what is the overall outlook on the positive or negative outlook of the entire ecosystem, which gives that either higher side plus or a lower side negative on the stock prices, and which is we call also sentiments. So you have to discount that also. But from that perspective, when we look at ratios, typically ratios, as I said, when you are deciding which company to buy or invest into stocks, from the overall perspective, we said in which business model, what is the business model, how does business model works, what is the management and all that. But when you look at the brass tacks numbers, then the first numbers is obviously what are the overall earnings of the company. And
Okay.
in that earnings, what is the profitability ratio? So let's say if I'm making 100 crore of revenue, and I'm making 25%, 25 crore of profit, let's say 100 crore of revenue, 25 crore of profit. So my earnings percentage is 25%, right? And somebody else may be earning only 30 crores, but or let's say 40 crores, but their sales is 400 crores.
Yes.
So while one company is making 40 crores, one is 25 crores, but one company is making that out of only 100 crore sales, and the one company is making it out 400 crore sales. So the profit earnings ratios is very, very critical. That how that gives you how efficiently the operations are being run, how efficiently the costs are being controlled. Another most important aspect, and a very, very simple ratio to understand, is the debt to equity ratio, because the companies are run by taking debt also, and the companies are run through purely on equity capital also. The
Yes.
lower the debt, obviously better the prospects are, because if you have a debt, you have to service the debt also. So when the debt servicing comes, the another important ratio which comes into factor is the interest coverage ratio. That what is the interest component which the company has to pay year on year, and what is the overall income company is generating out of which the interest payment can be done. So I memean, from that perspective, I think these are the very, very basic ratios which tells you the operational efficiency of the company. And then you can go to a lot of other ratios, where there are hundreds of ratios to further go
Absolutely.
on, and that which one is earning per share also you look at it. So what is the share price earning which you are getting per share? What is the total profit? But I think largely on a very, very basic note, the important factors is debt to equity. Another important ratio is what is the operating profit margins. These are the, if you really ask me, these are the two very, very important ratios. And then obviously earning per share, price to earnings tells you that what is the value you are getting out of your each rupee you are investing into that company. So plus agar now if you go a little deeper into it, and if you are into a manufacturing kind of in setup, and a company is into manufacturing, then you also, one of the important ratio is the inventory turnover ratio when we look at it. So basically what it tells you that what is the turnover ratio of the inventory. If the inventory is lying idle in the storage for long, that means either company is not able to produce, or company has over purchased the inventory, or ultimately final product is not selling, hence the inventory is not churning. So this
Right.
gives you a sense of that what is the churning happening on the inventory side. If it is very high, then it is a good, that means company is able to consume those inventory, produce the products, and sell the products as well. That cycle is complete, hence only the inventory turnover ratio is higher. So this, from the manufacturing perspective, it gives you a sense there that it's a running business, the product is selling in the market, and hence the revenues would be definitely there out of this, and there's a demand of that product.
So basically cash flow efficiency.
Yeah, absolutely correct. So basically, it is more of a cash flow efficiency and operating profit margins. If these
Okay.
two
Yes.
are, you can have an ascertainment on the positive note, then you're fairly on track that company is doing business is happening, and they are doing sales, and revenues are getting generated, and they are
Okay.
efficient.
Okay. Fine. So now I'll come to one very typical question. Almost every investors have in their mind. What to decide first, sector or company?
Ideally, sector and then the
Okay.
company, because if sector is going to do good, even a non-efficient player, by sheer demand of the product, will also do relatively better.
Okay.
So sector is a broader term, and from
Mhm.
the sector you narrow down to a company.
Okay.
So from that perspective, it is always good to first look at a sector and then look at
Okay.
the company.
So basically, if I'm new to this, I'm new to investments. First, I need to go to, see which sectors are likely to do well or doing well. So the best company working in that particular sector, there we should invest. Correct?
Absolutely. So if you look at an example of a COVID, any hospitality company, there are a lot of good hospitality companies. But as a sector, it is having a strong headwinds, and it is
Yes.
not growing. So however good that company runs the hospitality business, if there is no demand for some reasons, which is not in their control,
Correct.
then it won't be able to perform.
Right.
But if the sector is booming, then
Mhm.
even if you're less efficient, the product demand will be there.
Correct. Okay. So now let's come to the portfolio part. How to build a portfolio? Because now we got to know that how a stock market functions, how to choose a stocks. Now, how to build portfolio?
I think the most important word in the portfolio building is diversification. One
Okay.
should never have all the eggs in the same basket, as we keep saying, as an old age saying. So it should be a mix of debt, equity, and alternate assets. So which can be in the form of gold, ETFs, and all that. So it should be a mix of it, because so that you can balance your portfolio, and which also gives you a more diversified approach, and also gives you a liquidity aspect, which sometimes is good with a particular asset class and sometimes less. So let's say if you put everything in equity with a long term perspective, but in the being the cyclical nature of the market, if the markets are down at a particular point of time, and you want a certain money to be moved out of that portfolio for your consumption, then at that point of time you may have to book losses. But at the same time, if your portfolio is fairly diversified basis your risk appetite and risk profile, then at that particular point of time, even if one asset class in the negative bias, your other asset class will pitch in and fill that gap. So diversification is very, very important. How much should be equity, how much should be debt, and how much should be alternate in terms of gold or a silver is purely dependent on which phase of your human life cycle you are into. What is your total earnings? What is your total risk appetite? What is your approach towards the portfolio duration? What long duration investments you are looking at? And what is your overall risk appetite? Which is also a psychological in nature at sometimes. So how comfortable I am taking risk is also important. So we always sometimes envy that lot of businessmen that doing so great, and we are sometimes a salaried person look at it. If I also do that business, then I would have been earning more than what I'm earning. But the kind of a risk the business person is taking by being into that business is giving him that kind of an extra return by being more having a better risk appetite on a long term duration. So he's getting the benefit of that. So that is to so that way risk understanding your own risk appetite is sometimes is actually very, very important, and the key factor in building the percentages of various asset classes in the portfolio.
Okay. So let me put the same question in different way. How to build equity portfolio?
So now, if let's say you have decided that what percentage of my portfolio
Right.
is to be equity. Now there are various ways to invest into equities. You can invest through a good mutual fund scheme.
Mhm.
Within mutual fund schemes, then you can choose either between a large cap or a combination or a multi cap or a mid and a small cap focus fund. If you're or you can always look at an ETF in investment into ETF or an index fund. You can look at it. If you're early investor and you do not have too much time to explore and read and do your own set of study, the mutual fund, I guess, are one of the best in terms of investing. And to start with, you should focus on a large cap portfolio, because as I said in my previous questions, a large cap is, let's say, typically we define a large cap the top 100 companies in listed companies in our stock market today, and where the market cap is close to at least upwards of 20,000 crore for these companies. So
Yes.
why it is 20,000 crore is for the simple reason they have done something good consistently over a period of years, and hence they have reached to this level. So that means you are betting on a, I'll not say betting, you are counting on a track record.
Okay.
So that
Yes.
way, large cap is a safer, relatively safer, I'll say, proposition to start with. And similarly, if you can study a bit on the stock sides, and as we discussed, 4 5 parameters. If you look at it, sector, business model, manage, understand about the management, certain ratios, and all that, then picking up a stock again to begin with, I'll say the better of the side is obviously the large caps. Again, from the same reason, they have done the performance for the last so many years, so you can count on the track record. But you can also then look if you can take a little better risk or a more risk, then you can always get into a mid cap or a small cap. Uh, so up to us, but yes, for very early investors, very new age investors, I think one should focus on large caps.
So irrespective whether you are investing in a mutual fund or you are investing in a direct stocks, one should begin with large caps because they are less volatile as compared to mid and small cap.
Absolutely.
Correct?
So by the time you spend some time into that investment, you understand the bit of cycles of volatility and all that, and you don't get very deep shocks in the process. Because yes, there would be upside and downside, but they would not be as volatile as it could come out in a mid and a small. So you become comfortable with that. So it's like when you're running, you start running with a smaller pace, and then you slowly increase your pace over a period of time. You don't do 100-meter sprint day one, So start slowly so that you become comfortable with the investment and overall activities associated with an investment. When you become more comfortable, then you start diversifying into more riskier assets, which is a mid cap and a small cap. But then we are fairly, you've got your shock absorbers in place, you know. Uh,
Absolutely.
so then you're more comfortable.
Okay. So in fact, the next part is volatility. How to handle the volatility? Because typically what happens when there is little bit of volatility in the market, typically new investors, they do panic selling. So how to handle the volatility? Expert tips on that.
So it's actually very simple. The answer is very simple. Just stay calm and remain invested, and don't look at the noises to daily. So if you have invested into a large cap stock, or you have invested into a large cap fund, or even for that matter, you have invested into a multi cap which has some set of mid cap and a small cap, what is your objective? Your objective is long term. Here, when you're investing into equity and we're talking about long term, I'll say long term should be at least 5 years. Long term is not 1 year, 2 year. Long term is 5 years. So if you have decided to invest into a asset class which is equity with a 5 year perspective, then don't look at your portfolio every third minute or a third day.
Yes.
Stay calm, stay invested. 25-year CAGR return of indices is close to 14.5%.
Yes.
So the market has given consistent return over a period of time. So even if you look at a small data, so out of this 30, so when you look at the Sensex, it has been existing for so long. So 34 years in this period, Sensex has given positive returns. I'm looking at year 365 days, point to point return, matlab 1st January to 31st December return when you look at it.
Okay.
Out of that, 34 years have been positive returns. Only 11 years are negative returns.
Okay.
So if you look at from that perspective, yes, you may choose to have panicked in a year when it has got given a negative return, but at only 1/3 of the time the returns are negative in a year, and rest all 2/3 of the time it is positive. Rather, only 25% time it is negative return in a point to point in a year, and just 75% time is positive. So I'll actually say it's very difficult to lose money in equity.
Right.
It's very difficult if you're patient in the market and you're well diversified, then very difficult to lose money in this market, especially when you're into an economy, it's a growing economy like India.
Okay.
So stay
So what
calm,
would be,
remain
yeah,
invested, don't overreact.
don't overreact. Okay. So here, what would be your advice to investor in this current market scenario? What would you like to advise?
So in this market, so I'll say that there is no right or wrong time to enter the market.
Okay.
Every time is a good time to start investing. So
Correct.
markets have made new highs in the last so many years. So when even if I look at Nifty at some point of time when it was trading at around 3,000, we said it is a new high. It became 5,000, it was a new high. It became 10,000, it was a new high. It became 15,000, it was a new high. 22,000, new high. 30,000 will also be a new high. 50,000 will also be a new high. So from that perspective, there is no right or wrong time to invest into the markets. As they say that, what is the right time to plant a tree? So either
Exactly.
it was 10 years back when you have put in a seed and it would have become a tree now, or it is today. So same
Absolutely.
applies to equity. So either was 10 years back a right time to invest? Absolutely yes. Was 5 year back a right time to invest? Yes. Is today a right time to invest? Yes. So every time is a right time to invest with the perspective of long-term gains which you can incur, and you should have the discipline of investing.
Absolutely.
So in the investing world, or for that matter, to be successful anywhere in any field, one word which is most important is discipline.
Absolutely.
So you are a sports person, you have to be disciplined in your exercise regime, you have to be disciplined in your practice sessions, you have to be disciplined in what you are eating. If you're not disciplined, you won't be a successful sports person. If you're a
Absolutely.
student preparing for exams, you have to be disciplined. If you try to study only on the last day, one day prior to the exam, you won't be able to do anything great. But if you're 365 days, you're even studying 1 hour in a day or 2 hours in a day with that disciplined approach, you will get best of the marks. Same is stock market. So discipline is the word which is applicable to any industry, any profession, anywhere. And here also it is no different.
Okay. So basically, you mean to say that if you're investing in equity market, you need to be patient, you need to be calm and diversified, and stay invested for long term.
Absolutely.
Correct. The longer the horizon, the probability of getting negative return is much lesser.
Absolutely correct.
Okay. So that's great conversation, sir. In fact, it was indeed a very informative session, and we hope that our viewers will benefit from it.
I hope so. I think probably could give you some insights on a more simple, in the simplest possible manner. Um, so that is only very important here is, as I keep telling, equity investment is the very simple thing. With a long term perspective, it is you really have to be very unlucky to lose money. If you're
Absolutely.
patient and disciplined, you will make returns out of this market, and you really have to be very stupid or unlucky to lose your returns in this market with a long term perspective.
So with this, we have come to the end of this today's episode. Sir, thank you so much for joining us today. It was really amazing.
Thank you once again, Kundan, for hosting me.
Thank you, sir. So viewers, we have hope you have enjoyed our conversation today. Please don't forget to share your comments and feedback on this episode. You can also share your suggestion and questions at editor@outlookmoney.com. We will be back with our next edition soon. Till then, stay safe, stay invested, keep investing, and keep following Outlook Money, your favorite personal finance magazine. Thank you.